Good afternoon, everybody. John King, and here for my weekly mortgage market update. Thank you for joining me. I've got some of you that are live on Zoom. I've got some of you that are live on Facebook. So as people continue to join, just remember that I want this to be as interactive as necessary in order to give you the best information I can get you. So if you have questions, feel free to post the questions in group chats. If you are on Zoom, I'll get to those pretty quickly. If you are on Facebook, I won't get to those anywhere near as quickly. But let's go ahead and get started, and let me know if you guys have questions about anything as we proceed along. So let's dive right in. So first and foremost, what am I going to cover? So we're going to talk about rate update like I do every single week. We're going to talk about a forbearance update like I do every single week. And then I'm going to talk about a couple of topics. First one is the unemployment impact on housing. Where is that going? What do I see that meaning to the housing market, and kind of give you some color on what I see. And I'd love to hear kind of what your guys' thoughts are on that as well, so that we can make this as participatory as we can. And then we're going to talk about how people make decisions. I think that's something really important in the market that we're in. It's a really, really tight market, and it is hard to get offers accepted. You're competing against a lot of people. And so we've got to help our buyers make decisions quickly, but make appropriate decisions. And people often are their own worst enemy in making decisions. So I'm going to give you some tools and a simplified way to look at that so that you can help people to make faster decisions that give them more insight into what is the right thing for them. We're not selling them something they don't need, but we're absolutely giving them the tools to get out of their own way and make a good decision. Then we'll have a little time for Q&A. So let's get started. All right, so rate update. Here's where we're at for the market. First of all, as you can see, the rates have been actually, I keep saying stability for the last 60 days. The truth is, it's been improving. So this chart, as I've told you guys every single week, this chart is higher is better for interest rates, because this is essentially what Wall Street is saying. Hey, we think a mortgage is worth X amount of money, and the higher it's worth, the less rate they want in return. And this is good news. So we're in a pattern right now ever since early July, where we're right around this range, and it's been up or down in between that range. And very simply, where that puts us is in the high 2% range, better numbers than what we saw even at the beginning of March. So we're seeing super, super good interest rates. For the average 30-year fixed FHA loan, we're at like 2.75. For the average conventional loan, we're 2.8 to 2.99. Again, every circumstance is different, but truth is, rates are simply amazing. I'll talk a little bit about how far down I think interest rates can go, and give you guys kind of some insight into what that's going to look like. The Fed has not changed their thought process. They are continuing to be the biggest buyer of mortgage-backed securities. They're continuing to hold true the concept I've been preaching for the last 4 months, which is we expect rates to stay the same or go down. What you have to be careful about is to make sure that your buyers don't get into the thought process of, well, I want to wait then to time the market because I think it can go lower. Because if rates drop further, housing prices are going to go up even more, because somebody's buying power has been extended. And you need to explain that to your buyers, because I've heard some people say, you know what, I'm going to sit back and wait and see where this goes, because either housing prices are going to drop or rates are going to drop further, and either way I win. And I totally disagree, because if interest rates drop, people's buying power is going up, and the frenzy will get even bigger, and you're going to see people bidding up prices. If you buy now, you can refinance in 6 months or a year if the numbers make sense, if rates are that much lower. The election's going to have a lot to do with this. I'm not going to get political about it, just being clear that every election year, every major presidential election year, the rates typically stay low through the election. And then depending upon how the election goes, they typically go up from there. But we're not in a normal year. With COVID and the issues we're dealing with, that's really going to play into how this market plays out. But if you've got somebody wanting to sit on the sidelines, I say lock in your interest rate now, because if housing prices do drop, rates are going to skyrocket. And if that happens, you're going to spend way more in monthly payment for the house. So unless you're paying cash, if you're paying cash, wait for the housing prices to drop if that's what you think is going to happen. But if you're borrowing money, your interest rate determines your payment at a much bigger factor than your purchase price. So that buyer who's financing their loan is better off buying now at a lower interest rate. Even if housing prices were to drop later, they're going to spend way more at a higher interest rate later. And if rates drop further, you've already got the home, you've locked in your price. If values go up, then they have an increase in equity and now they can refinance the property and get a lower interest rate with the original locked in purchase price. So really, really important that we help our buyers understand that concept and not to wait for interest rates to drop. But as I've said all along for the last 4 months, if you're refinancing, get in line now because the process is taking over 60 days from start to finish because we are prioritizing our purchases. I'm getting purchases closed in 21 to 30 days, no problem, because we're making the purchases a priority. But it means the refinances aren't a priority, but that's okay because you get in line for that refinance 60 days or so when we're ready to lock, it is likely interest rates are the same or lower and you end up getting an even better deal. Hopefully that makes sense. Again, post in comments on Zoom or on Facebook if you have any questions about that. Let's dive into the second topic, which is the forbearance update. So I'll start with the chart and then I'll kind of explain the numbers. So this top number is the total number of forbearances. And as we've been talking about for the last few months, the number of people actively in forbearance has been climbing, and then it flattened out in early May. And then we saw a bit of a dip at the beginning of July, and now it has somewhat flattened out. What you're seeing really is Fannie Mae and Freddie Mac loans represent a greater number of people who are in forbearance, but that's because there are so many more people that have Fannie Mae and Freddie Mac loans. But the truth is, FHA and VA loans as a percentage of homeowners with those loans is more than double what the forbearance rate is for conventional loans. So what you'll see on the next page here is what you saw on the chart. We have another decline in forbearance numbers. That's all good news, but I don't know if it's anything other than the fact that we're now 4 months after forbearance started because March was the first month that you were able to file forbearance. Most people went into the default, not went into default, the default time frame for forbearances was 3 months, which means their forbearance is automatically up. And unless they have a true hardship where they need more time, even the people who didn't purposefully get into forbearance, they're making the shift to, okay, now I should start making my payment again. So I don't know if it's really indicative of a change in the economy, because clearly we're not seeing it. I don't think it's indicative in a change in the market. What I see it as is simply the people who got into forbearance that may or may not have truly needed it. Well, those people are now getting out of forbearance because they've run their course of the first time frame of 90 days in forbearance. So the totals are down by 27,000 people compared to the prior week's lowest rate since the peak in May. Most of that decline came from Fannie Mae and Freddie Mac portfolios. So people who are in FHA and VA, they really aren't getting out of forbearance. That's an interesting dynamic. Not really sure how that's going to play out, but it is interesting to note that most of the people who are completing forbearance and getting out of the process are conventional borrowers, and our FHA and VA borrowers are not getting out of the process. Not real sure what's causing that. We'll see over the coming weeks and months how that plays out, but it is a pretty interesting factor that's happening right now. All right, so let's talk about unemployment and the impact on housing. So first of all, I've got a couple of general comments on the slide here. So this week is the last week of this extra $600 of pandemic unemployment PUA assistance, pandemic unemployment assistance. So this is the last week. It officially ends on July 31st, but they pay unemployment benefits based on a calendar week. And because July 31st happens in the middle of the calendar week, this is the last week that people are getting the extra $600. That I read a statistic. I think it said like 38% of the people on unemployment are making more money right now than they were making when they were employed. What's going to happen next week when those people are no longer receiving their $2,400 a month of pandemic unemployment assistance? Again, I have no desire to make this a political commentary, more just a statement of fact. We're going to see some challenges that arise from that. We're going to see that, yes, is Congress trying to extend that? They sure are. Is it going to be extended in the same manner with the same dollar amount as it's got right now? Who knows? Is it going to get extended before the current benefit expires? I highly, highly doubt it. So now we've got to figure out in the meantime how somebody's going to live on $240 a week. That's a huge decrease over what they were making previously. We're going to see more fallout from that. We're going to see more challenges because I read another statistic. They were talking about the GDP, the gross domestic product of the United States. And something like 70%, I'm trying to find the statistic here in my notes, but it was something like 70%, yep, 70% of the GDP is made up of consumer spending. So if consumers don't have money to spend, that's going to get us deeper into the recession that we're already in. Now, the government's going to do everything they can to keep us out of that, but we're kind of hitting that point where the assistance has propped us up and kept us going this far. We've run into some challenges with renters being able to pay their rent, which is the next bullet point here, where we had a moratorium on eviction. Another statistic that I read, and again, statistics are like anything, 82% of statistics are made up, including the one that I just told you. So you don't know what you can trust for sure, but I try and get this stuff from trustworthy sources. And another statistic I read said as many as 20% of the tenants out there right now are eligible for eviction. In other words, they're behind on their rent payments. That puts the landlord in a tough position. It puts, first of all, we've got the moratorium that's supposed to expire at the end of August. Is that going to get extended or not? If it gets extended, now you got the landlord having to carry that burden, having to carry their mortgage payment without receiving the income. Are you going to see more people filing for unemployment, or not unemployment, for forbearance because of that? I don't know. Not to mention the fact that we're seeing more shutdowns and more curtailment of business activities because of this next wave of COVID breakouts that are happening in multiple states. All of these factors are creating a lot of unknowns and uncertainty, and unknowns and uncertainty is great for interest rates. But the truth is you've got consumer confidence. You have somebody's willingness and desire to, how confident am I that I'm going to be able to afford to make this payment for the next 30 years? Currently, the impact on unemployment is happening at the lower tier of the income earning scale. So the people who are making the least amount of money, the service workers, the people who work in hospitality, those are the people that are being impacted the most due to unemployment. And as I've said a few times in the past, those people are not typically the people that are in that market to buy houses. So proportionally, housing is not being impacted very much by this unemployment number. But I'll tell you, that doesn't keep us completely immune, especially if we have deeper impacts to the economy. If this drags out a lot further and we have people not getting their unemployment assistance and not being able to make their payment to their landlord, now the landlord's getting impacted even deeper. Sooner or later, they're going to end up in default. And the silver lining is how much equity there is in the housing market right now. What I have zero expectation of seeing is the decline that we saw in the housing market like we saw in 2007, 8, and 9. Because that decline came from the domino effect of, hey, my neighbor lost their house, that dropped the value. I had to refinance because I've got an ARM and my value is too low to refinance, so I'm losing my house. Therefore, I dropped the house values. Now my neighbor, the other neighbor can't refinance, and it was a domino impact. Today is the exact opposite. If somebody has lost their job and they can't afford to make the payment, they sell their house. And there is so much demand right now that that demand would eat up that inventory without a problem, and the seller walks away with cash in their pocket to move on to the next phase in their life. So keep that in mind. I don't know how we use that information to help us figure out this shortage in inventory, because clearly people who are being harmed with loss of jobs and inability to pay, at a certain point, they're going to have to sell their home. And I know there's a lot of people, I've talked to people who have had tough decisions. There's a lot of people filing bankruptcy right now. So if you're not already talking to bankruptcy attorneys, you need to start doing that. If you're looking for opportunities, and it's really the thing that I learned a long time ago. And somebody said, figure out who your client is, and then figure out who your client talks to before they know they need you. As an example, my client might be somebody who is a high wage earner that is a renter and needs a tax write-off, and that's why they want to buy a home. That's a great first-time home buyer. Somebody who makes a good amount of income and they know that they need to buy a home in order to be to get a tax write-off. Well, who is that person talking to before they even realize they need a home? They're talking to their CPA. So you want to be getting to know CPAs, because the CPA is going to be the conduit that says, hey, Bob, you need to buy a home. You're paying way too much in taxes. Same holds true for bankruptcy attorneys. The truth is people are going to be going through bankruptcy and they're going to be deciding that their best asset is in their home and they should sell it. Then get to know bankruptcy attorneys and become their best referral source for people that have questions about selling their property, because there's huge opportunity there for you if you just focus on the right markets. Um, Here's another issue with unemployment. We've got the PPP that is winding down. Now, it's a little bit confusing, and I've mentioned this before, but I'll very simply say the PPP money was a set amount of money that employers had to spend in a certain period of time. And they set aside, they extended that amount of time that people have to spend the money, but they had to spend it on staff. They had to spend it on payroll. But when that free money of the PPP money runs out, are they going to keep people on payroll, or are they going to start shedding that payroll expense and letting people go? I think we're in for a little bit of an increase in the unemployment numbers in the next month or two because of, at least in one part, because of the PPP money starting to be exhausted, and employers are now starting to say, I just can't afford to keep this person on payroll. And the other thing is, there's a lot of celebration going on in the economic market saying, oh my gosh, the unemployment numbers are back down. Last week, 1.3 million people filed for first-time unemployment. 1.3 million people filed for first-time unemployment. That means that is 7 times the normal number of people that had filed for unemployment in a 1-week period prior to COVID. We still have a problem. We still have people losing jobs, and we have to be aware of how that's going to play out in the market. Again, economically, it's good news for the interest rate market, because as the economy struggles, the Fed has to step in and keep pushing rates lower to keep spurring spending, because like I said, 70% of the gross domestic product is consumer spending. So there's a lot of components here. The big picture that you have to realize is that unemployment is going to have a big play on interest rates. And I want to kind of talk about how low rates can go. So here's where we're at. There really are 3 major factors that are going into the market right now. The first is COVID. COVID is going to continue to be the #1 factor driving the stock market, driving the interest rate market, because the fear and concern over COVID is predominant and is overriding all other economic indicators. So what you're going to find is you're going to find days when there's good news about COVID, that the 10-year Treasury and rates are going to tick up a little bit, and days where there's bad news and that case counts are going up and states and counties are starting to shut down more. That's going to cause the market and interest rates to go down. But unemployment is going to be a big factor in this, because what we're really going to see is we're going to see a bigger disconnect than we've had in the interest rate for the 10-year Treasury compared to the interest rate for mortgages. And I've talked about this a few times over the last 3 or 4 months, but I want to revisit it real quick. A lot of people think, hey, there's just a general difference between what the 10-year Treasury rate is and what a mortgage rate is. It's called the spread. And that spread is pretty typical, and historically it has been. When the 10-year Treasury goes up, mortgage rates go up. When the 10-year Treasury goes down, mortgage rates go down. But there's reasons why they disconnect from one another. And here's one of them that I fear playing out. And it is the fact that a 10-year Treasury is it's basically borrowing money from the federal government. And in general, the federal government is considered to be a guaranteed repayment, meaning the government has never yet defaulted on a Treasury bond, and there really is no expectation that they're going to. And so if you invest money in 10-year Treasury bonds, you're going to get your money back with the interest that was promised. You can't guarantee that when you've got a homeowner making a mortgage payment, especially if unemployment becomes a bigger and bigger issue. And so you may have times where the market says rates should be lower, the 10-year Treasury is dropping, the economy says rates should be lower, but you aren't seeing them passed along to mortgage rates, because those same factors that are causing the economy to be fearful and pull back and get interest rates lower are also directly impacting home buyers and homeowners' ability to make their mortgage payment. And that makes mortgage lenders fearful that they won't be receiving the income they're expected to receive. Here's the other reason why they're going to have a disconnect, and we're already seeing that for the last 3 or 4 months. It's capacity issues. Guys, if you didn't know this already, the mortgage industry is buried. Good lenders are prioritizing their purchase business, but we are buried. There are more loans to be done right now than any of us can do. That's a great problem to have. But if you were in that position and you had a whole bunch of sellers wanting to list their home with you, and you had a choice, and you said, hey, you know what? I have the option of decreasing the commission that I'm charging or keeping it the same, and your cost of doing business went down, your fees from your brokerage went down, everything went down, and you're like, hey, you know what? I can go ahead and drop my cost of doing business and charge my sellers less money. You can. The problem is you already can't keep up with the amount of people that want you to list their home. So why are you going to drop your fee to make more people want to list their home with you when you already can't keep up with the demand that you have today? That's what the mortgage industry is dealing with. That's why you aren't seeing interest rates drop more. That's why I keep saying it's a safe bet on refinancing for you to not lock your interest rate, because even if the 10-year Treasury goes up, there is such a big spread between where rates are right now and where they should be. And that's because the lending industry is artificially keeping rates higher to stem the volume of business coming in the door. Okay. So a couple other pieces to this as far as how low rates can go is part of it is just plain factual. There's a floor. So mortgage rates are pooled, or mortgages are pooled into what's called a coupon. And coupons are in 0.5% increments. So there's a 2%, a 2.5%, and a 3% coupon. The rate for the borrower must be at least 0.25% above the coupon rate. Right now, back in May, we finally started trading 2% coupons, and I told you guys that rates could fall by 0.5% if that coupon becomes the predominantly traded coupon, and it's on its way to be. But there's still a floor, and it says that if the lowest coupon is 2%, then rates literally cannot go below 2.25% no matter what, because it's mandated that the rate to the consumer has to be 0.25% above the coupon. Now, can there be a 1.5% coupon that starts trading? Sure, there can. But just like a 2.5 was the predominantly low coupon for a long time, and it was only a few months ago that the 2% coupon came out, there's never, ever, ever in history been a 1.5% mortgage coupon. All-time lows are created because things that never happened before happen, but I'm telling you, it's going to take a big shift for a 1.5% coupon to come out. So currently, we're about 0.5% to 0.75% above the floor of where rates can go. That's a lot of room for rates to drop. And I don't know if they're going to fall that far until everybody who can refinance at 2.75 does it. Then maybe when the volume of business coming in the door slows down, then and only then do I see lenders pushing rates lower than about 2.75 on a 30-year. I personally feel that's the lowest it's going to get until or unless the volume of business coming in the door slows down. So hopefully that makes sense when we talk about how low rates can go. I've covered a lot so far. I'm going to switch to the last part of my conversation, which is how people make decisions. As I've told you guys over the last few weeks, I'm trying to keep these to once a week at 30 minutes, just to kind of keep a condensed version of all of the new information that I think you want to get. Feel free to post into comments on Zoom or on Facebook if you have questions or anything you want me to cover. Otherwise, I'm going to move into how people make decisions. So there's 3 ways that people make decisions. They make decisions through their head, their heart, and their gut. So if you use your head, you are a thinker. If you use your heart, you're a feeler. And if you use your gut, you're a knower. And we all have a component of all 3 of those things. But the first thing you have to decide is how people digest information, because they digest information using what we call their primary mode or primary modality. And so you say to somebody, hey, we want to look at the housing market. So here's what I can do for you. I can send you a list of all the homes with all the statistics, and I can break down everything about every home into a spreadsheet so that you can see all of those things. Or I can send you some photos of the properties and do some virtual tours and show you what the properties look like, and then we can go visit them. Or I can just give you kind of a brief synopsis that says, hey, here's the 3 homes that meet your criteria, and I'm going to stack rank them based upon what's the best price and what's the best location for what you're looking for, and give you just kind of the bullet points of what you want. Mr. Buyer, which of these 3 ways would you like me to present the information to you? If you did that every single time, if you simply ask them those questions in some way, shape, or form, to whether you do it via email or whether you do it through a conversation, whatever their answer is, That's their primary modality. Never, never, never sell to the primary modality, because all you're doing is giving them more information to consider. People never make their decision to buy in their primary modality. And that is the flaw that everybody makes. When you know that somebody is a thinker, because they're an engineer and they're asking for all of the information, all of the questions, then when you want to help them make a decision about which home, you say, hey, I know you're not sure which house you want, so let me give you more information about the houses. All they're going to do is explode with information overload. Somebody who's a feeler, and you've seen all these houses, are like, well, I can't decide between them because I really like the front yard of this one, and I really like the kitchen of that one, and I could really see myself sitting on that swing out in the backyard on the third one, so I'm not really sure. The worst thing you can do is say, well, let's go back and visit them all again and see how you feel. That's the worst thing you can do, because all you're doing is playing into their indecision. So you need to figure out what is their secondary modality. People filter the data using their primary modality. They make the decision using their secondary modality. So once you know what their primary modality is, you have a 50-50 shot at knowing what their secondary modality is. Take a swing for it. Try and figure out what their secondary modality is by asking them a question while you're out looking at homes. Now you can interpret this and change it for listings, but I'm using the buyer side of it because right now buyers, it is harder to help them make a decision quickly for some buyers because they want to think about the home. They want to think if it's the right one. And by the time they've thought about it, somebody else has bought the home. So this is where it's really, really important for me to help them make the right decision. So you ask them a question and you say, hey, what do you think about the house you just saw? And how they answer will give you their primary modality. But now you test the waters and you say, well, when you really think about it, does this home check all the boxes? Okay, I even forgot the XS on there. So clearly I'm not a thinker because I didn't double check all my I's and T's. So does this home check all the boxes for you? And if they're not a thinker, let's say that you know that they're a feeler or a knower, by asking them a thinker question, they're either going to respond with, yeah, it really does, or God, I don't really know. I don't think I really have boxes for it. If they answer in a way that is a definitive yes or no, then you found their secondary modality. But if they answer in a way that is indecisive, you're wrong. And that's okay to be wrong because now you know the remaining modality is their secondary modality. So you can ask them a question about, hey, does this check all the boxes for you? You can that puts them into the thinking mode if you're trying to see if they're a thinker. If you're trying to see if they're a feeler, like if you know they're a thinker or you know that they're a knower and you simply want to say, are you a feeler? You say, well, hey, how did you feel when you were in this home? How does this house feel to you? Can you see yourself in this home? You ask questions that talk about the feeling and the emotion of the home. Again, if they give you a clear yes or a clear no, you found it. If they're indecisive, it means you figured out it's not that one. And the final way to test if it's a gut decision maker is to just say it. Which home does your gut say is the right home? Does your gut say this is the right house for you or not? And when you ask the question in the right way, if it's their secondary modality in their gut, they're going to say, you know what? Yeah, my gut does say it's the right home. No, my gut says this is the wrong home. But bingo, you've just found what their secondary modality is. Here's the key to all of that. You simply have to realize that people make decisions different than how they process information. So if they process information through one of these three modalities, you can check that one off as not being the way they make decisions. And then you focus on figuring out what is the way that you make decisions. You got a 50-50 chance left over. But now if you figure it out early in the process, how they make decisions, you can speak to that secondary modality and help them figure out quickly, is this the right thing for me or not? Hugely important way for you to help your clients get out of their own way, especially the thinkers. The worst thing you can do is give a thinker more information because the thinker will be suffering from paralysis by analysis. So guys, hopefully that was helpful. Again, I try and stick to the 30-minute time frame, and it is 30 minutes right now. So if you have questions about anything, please feel free to holler at me, post in Zoom or on Facebook, any questions that you have. Otherwise, I'm really happy to keep you guys updated on the market and give you any nuggets that I can give you about how to help improve your business. If you have any questions at all, give me a holler. Otherwise, have an absolutely amazing week, and we'll talk to you all soon. Bye-bye.